about how do you actually use the equity in your home to help you build up an investment property portfolio. Well, simply speaking, when you go to the bank or a lending institution to be able to borrow money, there's two things that they look at. The first thing is the DSR, your debt servicing ratio, and what that's about is your cash flow. How much income do you have in relation to the expenses that you have, and how can you afford to repay the loan? The second thing they look at is your loan to value ratio, your LVR, and that's about how much debt you have versus how much equity you have. So when you go and borrow to buy an investment property, you've got to typically put a 20% deposit down. Now, over the last 5 or 6 years, we've seen borrowings of 90, 95, 100%, and a range of different styles of loans. But since we've had this whole credit crunch, banks are actually going back to a much more traditional sort of model that they've worked on, where you've got to use a 20% deposit to have about an 80% loan. So that's kind of a standard ratio that we had some half a dozen years ago, and we're kind of moving back to today because the banks are a lot more cautious. So when you go and buy an investment property, that would mean that you would put a 20% deposit down to borrow 80% for the loan. Okay, so if you want to use your equity in your own home, what you effectively do is use your own home for security against this rental property. So 20% of the equity in your home can actually provide the security for the property investment loan. So that means rather than putting down the 20% deposit, you use equity in your own home. You borrow 100% to buy your rental property. Now, the key advantage of that is because a mortgage on your own home is not deductible, whereas a mortgage on an investment property, because it's for investment and business reasons, is fully tax deductible. So you want to get as much debt as you can on your investment property and as little as you possibly can on your own home. And that is all there is to it, is to using your equity in your own home to borrow for a rental property. And what they do is when they lend you money, they look at the value of your own home and the value of your rental property, combine them together and basically say, okay, well, we've got to have 20% equity between the two and 80% borrowing between the two also. So they look at it as a whole package.